Have you ever wondered why some people seem to pay off debt years faster than everyone else, even without making more money? What if I told you there's a strategy that focuses less on interest rates and more on cash flow? It's called velocity banking. Today I'm going to explain what velocity banking is, how it works, who it might be a good fit for, and some common mistakes people make when trying it on their own. My name is Fred Livai with Fred Livai Financial, and let's jump right in. What is velocity banking? Velocity banking is a cash flow management strategy that uses a line of credit, typically a HELOC, to help reduce debt more efficiently. The concept is simple. Most people receive income, deposit it into a checking account, pay bills throughout the month, and repeat that cycle over and over. With velocity banking, you use a line of credit as the center of your financial system. Instead of allowing debt balances to sit untouched while you make minimum payments, you're strategically using available credit and your income to reduce principal balances faster. The goal is not to borrow more money. The goal is to create movement of money that attacks debt more efficiently. Think of it like directing traffic. The money is already coming in and going out. Velocity banking simply changes the route. How does it work? Let's look at a simple example. Imagine you have a mortgage, a car loan, credit card debt, monthly income coming in. Instead of letting your income sit in a traditional checking account, you deposit your income into a line of credit. Because lines of credit calculate interest based on the daily balance, every dollar deposited immediately reduces the balance and lowers the interest being charged. Then, throughout the month, you pay your bills directly from that line of credit. As your income continues to flow in, it continually pushes the balance down. Many velocity banking strategies also involve taking chunks from the line of credit to target specific debts. Once a debt is eliminated, the monthly payment that used to go to that debt becomes additional cash flow. That additional cash flow can then be redirected toward the next debt. As the process repeats, more and more cash flow is freed up. That's where the acceleration starts happening. The real secret. Here's what most people get wrong. They think velocity banking is about finding a lower interest rate. It's not. The real power comes from improving cash flow. Cash flow is the amount of money left over after all of your bills are paid. If your debt payments total $2,000 per month and you eliminate one debt with a $500 monthly payment, you now have an extra $500 every month available. That's what creates momentum. In many cases, cash flow has a bigger impact than simply chasing a lower interest rate. When more of your income stays available each month, you gain control over your finances instead of your debt controlling you. Who is a good fit? Velocity banking is typically best for people who have steady income, have positive monthly cash flow, have discipline with spending, want a structured debt payoff strategy. It's not magic, and it's definitely not a one-size-fits-all solution. For some people, a debt snowball may work better. For others, debt avalanche, cash flow indexing, or even a customized strategy may produce better results. The key is understanding your numbers before implementing any plan. Closing, the biggest takeaway is this: velocity banking isn't about creating debt. It's about using cash flow strategically to reduce debt faster and create financial freedom sooner. When done correctly, it can potentially help you eliminate debt years ahead of schedule and save significant interest over time. If you'd like to see whether velocity banking makes sense for your situation, comment velocity below or send me a message. I'm Fred Livai with Fred Livai Financial, and I'd be happy to show you what your numbers could look like using a personalized analysis. Remember, it's not about how much money you make. It's about how efficiently your money moves. Talk to you soon.